You want to sell your property for millions, but don't want to do a 1031 exchange? This video is for you. Hi, my name is Zachary Jensen. I'm the managing partner here at TaxWise, where we're empowering small business owners to build more wealth through tax strategies. Today, we're going to go over some wealth preservation strategies that you can do after you sell a large property that are not related to a 1031 exchange. So if you don't want to go and just exchange your property for another property, this video is for you. I was just on a call today with a gentleman that has a property that he bought all the way back in the 1980s and has several $1 million gains on his hands. And this video couldn't have come sooner for him. So let's go over to number one, tax loss harvesting through stocks. So if you have stock accounts, which most of us do, and you have a loss, which a lot of us can have, especially when the markets are volatile, right? Markets are up and down and left and right. You can actually sell your stocks at a loss, creating a loss on paper, and then moving those stocks into other index funds, let's say. So let's say you're invested in a VTI, Total Market Index Fund. Well, if you sell at a loss and then move your money into an S&P 500, the assets are technically different, and that's what tax loss harvesting is. So if your losses exceed your gains, depending on your salary, you can actually even deduct a little bit against your active income. So that's something I just wanted to mention, but in general, for the folks that are watching this video, they're thinking about saving, millions of dollars potentially in capital gains. So what you would want to do is build up over time some losses on your passive side of your balance sheet. So if you have $1 million stock portfolio, it goes down to 800,000, sell, create that $200,000 loss, and then buy other stocks with that money. So that way, when it goes back up, you have those losses in your back pocket, and you can use those to offset your gain from the rental property. Number two is donating appreciated assets. So you can do a donor advised fund, which is something that a lot of people like to do. Also, charitable remainder trusts are a great option. Let's touch on both. So the donor advised fund is where you can donate stocks or property before selling, and you deduct the full market value while avoiding capital gains tax. You can actually do this for up to 30% of your adjusted gross income. And there are tax court cases to support this. So let's say you donated stock that was bought for $100,000 and now it's worth $500,000. Well, you can deduct $500,000 and skip out on that $400,000 gain. So it's a perfect way to offset any sort of additional capital gains on top of your property sale. Number three is a specialized trust plan itself. So you can actually do specialized trust planning like a grantor trust sale. You can sell your property to a defective grantor trust and no capital gains get recognized. Plus you freeze future appreciation outside your estate. So that's smart if you want to lock in its value and shift the growth to your heirs without immediate tax. You can also do an installment sale. This is a pretty common one. Instead of taking all the cash at once, you can structure the sale as payments over time, and you're only taxed on what you get paid that year. So if you spread income across years, you could potentially stay in lower tax brackets. You also have to keep in mind depreciation recapture is still taxed immediately, though. So you need to make sure you are aware of that and avoid any what's called monetized installment sales because those can lead to some issues. Number five is let's say you wanted to get into some more funds, right? Move that money into more passive investments. A qualified opportunity zone fund is going to be another good pick. You can roll your real estate gain into a qualified opportunity zone fund within 180 days and defer paying tax until let's say 2026, then you can hold the new investment for 10 years and future appreciation becomes 100% tax-free. So let's say you deferred the original gain until 2026, you'll owe taxes then, and you also have to commit to 10 years in that fund without unlocking the full benefits. So this is more of a long-term play, but still for many sellers, qualified opportunity funds offer a unique second chance at compounding wealth without the future capital gains. So each of these five strategies, right, tax loss harvesting, charitable giving, trust planning, installment sales, and qualified opportunity zones has its own complexities, but each one is backed by IRS codes. There's private letter rulings involved and real world cases that support all these sort of things. Definitely don't do this on your own. If you're looking for an accountant that knows this stuff, that's done it for folks before, feel free to reach out to us. Our contact information is in the description below, and we'll see from you soon. Thanks so much for watching, and have a great day.